Hello and welcome to Switzer TV Investing. I'm Peter Switzer. On tonight's show, we talk to the CEO of WCM. Now, this is a US fund with two funds listed on the Australian stock market, and this fund management company is one of the best performers in the world. And as I say, it's on the ASX. The CEO is Paul Black and is a great thinker and a great talker, like a lot of Americans that I know. I'm joined now by the CEO and portfolio manager of WCM Investment Management, which is a fund management group out of Laguna Beach in California, and they have listed products on the Australian stock market as well. Paul Black, thanks for joining us, mate.
Thank you, Peter. Great to be here again.
Paul, before we get into your great performance for the fund, a lot of people would wonder, how does someone become you? How does someone become a CEO and portfolio manager of a significant fund management company? So why don't you just give us, in a nutshell, where Paul Black came from and how you ended up where you are today?
What a terrific question, because it goes to one of our mantras here at WCM, which is 95% of life is showing up day after day after day after day, and just keep doing the best job you can. When I look back at my 30 odd years in the business, starting at a bank here in the States called Bank of America, which was the largest bank in the world in 1983 when I started, soon to almost be extinct in 1987 when we had the kind of the shock crash. And I started in the business in the trust division of a bank, not even knowing that there was anything called a portfolio management firm or a money management firm. And, fortunately, by showing up every day throughout my life, keep doing a good job, meet the right people at the right time. And 30 odd years ago, I met one of the founders of the firm that we now own. And he brought me into the business, and I started at every low-level job in the organization, did it well, and kept progressing slowly over time to the point where eventually 10 years ago became the co-CEO and president of the firm. But I will tell you, do I have talent? Yeah, I've got some talent. Am I fairly bright? I'm pretty bright. But you know what? At the end of the day, I got a couple of lucky breaks. And, it's really important, I think, for people that are in positions that might be enviable in some respects to acknowledge that, you know what, I got lucky. I did all the things you're supposed to do, but there are a lot of people that do all the things they're supposed to do, and they don't end up, being able to do something they love every day of their life with a group of people that they love working with. So I've been very fortunate and blessed.
I'm not sure if it was Gary Player or Lee Trevino, but one of them said that the more I practiced, the luckier I got.
Yeah, I think that was Gary Player. You're exactly right. And it didn't happen overnight. It's funny, people look at our firm now, we're $55 billion US, and they think, boy, that's unbelievable. You guys are successful. Well, you know what? And to them, it looks like it happened overnight. It didn't happen overnight. It was grinding every day for 30 years to finally figure out a different way of doing things, a different way of approaching the equity markets. And that different way led to success, but it took an awfully long time to do it. Nothing happens overnight, or very little good happens overnight.
For you personally, Paul, were there eureka moments when you learnt something that became critically important to your talent now? Or were there people who you either met or you were influenced by? I know Jim Collins, the author of Good to Great, as a young man said, he didn't have anyone who could be his mentor, so he read great books like the books that Peter Drucker wrote, and he kind of presumed that Drucker was giving him advice as he read the book. Do you have either people directly linked to you or other people? And I know in the case for me, Buffett was a very big influence in the way I invest, but were there people or things that were said to you that changed you and gave you this lucky break?
No, I think you're right, Peter. For me, it was books. It was about 20 years ago, I started reading all the classics, right? Intelligent Investor by Graham and Dodd. And really the only thing you need to focus on there are two chapters, Margin of Safety and Mr. Market. If you read those thoroughly and you understand them and get them, it's a huge advantage. Phil Fisher's Common Stocks and Uncommon Profits, one of Buffett's favorite books as well, was a huge teacher to me and really everyone in this firm about how important the qualitative side of analyzing a business happens to be. And then, of course, you've got to read Buffett's essays and letters. I think it was Lawrence Cunningham who put together the essays of Warren Buffett. I try to read that every couple of years. It's all his best letters and his best points, and you just keep kind of going through the fundamentals of what creates wealth over time. And there's only a few basic concepts. I mean, one of them is every great investor usually has a focused portfolio of no more than 40 names. They focus on their best ideas. They know those companies really well and they keep after it, and they give them a long time to perform. And not a long time is not a month or 2 or 3 or a year. A long time is decades. So, and it's so interesting in this day and age, everyone thinks in terms of days, not even quarters or years. And what creates wealth? You look at all the people that you know, Peter, that have made extraordinary amounts of money. They made it by doing the same thing for 30 years. And they did it through really hard periods of time. They hung in there, they showed up, and they kept doing it. And when the good times came, they were able to capitalize on it. So yeah, books definitely, life experiences of seeing how people create wealth over time, which is, again, as I said, showing up every day for 30 years. You have the best opportunity to achieve your goals if you do that.
Yeah. I know Jerry Harvey, who owns Harvey Norman, the department store here in Australia, he said to me that one of the best things he did as a young man was to hang out with a whole lot of old people who could teach him stuff. And
yes.
I'm sure both you and I have been in that sort of situation.
Absolutely. So reading a lot, I mean, there's just no substitute for reading and thinking. And again, it's contrary to what we get today, which is a lot of information that's very difficult to digest. That's not as important as really reading the classics.
Okay, mate, let's get down to having a look at your performance. We're halfway through arguably one of the worst years ever. The coronavirus worldwide has made 2020 an unforgettably bad year, but we also had the bushfires here in Australia.
Yes.
So how has your portfolio actually fared so far this year, Paul?
It's phenomenally well. Better than we could have hoped. Just to give you kind of a ballpark, and I'll kind of back into this. If you look at our global portfolio that we run for a lot of people in Australia, year to date through today, we're up almost 10%. Now that's stunning when you think that the market itself, if you measure it by the global indices or ACWI, is down 5.6%. So we're almost 150% better than what the market in general has delivered. And it's been on both sides. In the first quarter, when the market was down 23%, we were down only 16%. It was still a lot, but we were down a lot less than the market. And the really nice side of the portfolio is we did make a couple of moves in the portfolio. So when the market's risen, and people won't believe this, but so far this year, if you look at the general global indices, so far this quarter, the market's up about 20%, and we are up 25.5%. So we've done really well, and Peter, that we really build these portfolios to protect people in difficult markets. But you, of course, always want to participate in the upside. And when I think about all the fear 2 months ago that you could taste in the air when people were talking about the markets and what was going on, what was going to happen economically, that's when people should be acting and taking advantage of opportunities. It's very difficult to do, but it's one of the reasons that you hire a professional manager, because the professional manager, I think it's easier to disengage yourself from the fact that these are my personal assets and I've got to be, very fearful or careful right now. Historically, and Peter, you've been through a lot of market cycles, the time to create wealth and make money is when everybody's afraid. Buffett says it all the time, right? Be fearful when others are greedy and greedy when others are fearful. So if you can take that fear and make it work for you by buying these great businesses when people are selling them cheaply, you can position yourselves to do very, very well. You know, it's interesting. This is a very scary time for a lot of people, but this is the time when we earn the pay that people pay to us because we can generate good returns in this environment.
I noticed here in Australia when the panic was at its most, even the best of names fell because a lot of people just had to liquefy their assets, and some people were so scared they had to. But
Right.
but the great companies, the sort of companies that you guys would buy if you were only an Australian only company, they really rebounded the fastest. They didn't stay down for very long. Explain to people who don't know much about you guys what kind of companies are in your portfolio and why they would have, clearly given the percentage return you talked about, they must have been big rebounders.
Yeah, yes. You know, what we look for, and everybody in our business, as you know, Peter, says that they want to buy a high quality business. And usually the way they define high quality is, you know, they have very clean balance sheets, no debt, lots of returns on their assets and their capital. Usually a quality company is a company that's well known, that has a brand, some kind of franchise. And you know, that's typically what people focus on. What we focus on are all those things, but more importantly, we want to try to own businesses where the company itself is getting stronger from a competitive advantage side. We talk a lot about the idea that we want to own companies where the competitive advantage is likely to get stronger over the next decade versus weaker. And if you own those businesses that are likely to take share because they're positioned better in difficult times, that's going to translate into a very good stock return. So when you looked at the dislocations in the market, there were a lot of high quality companies, as you said, Peter, that sold off 40 or 50% only because the general market sold off. And I'm thinking particularly about healthcare. A lot of the healthcare names, you know, medical device companies like Stryker or Boston Scientific that make stents for the heart or make knees and artificial knees and hips, they got dragged down with the general market out of pure fear, and mostly because people thought, hey, you know what, we're not going to be doing elective surgeries anytime soon. Okay, that's true. But the businesses themselves did not radically change overnight. And the reality is, sooner rather than later, people are going to be getting new hips, they're going to be getting stents in their hearts, and they're going to be getting new knees. And so those businesses you could buy at a 50% discount to where they were a couple of months ago. And if you know, again, long enough time frame, you're going to do well. They've already snapped back pretty powerfully. And if you think about it, people are not going to go long without replacing their knees, hips, or putting a stent in their heart. Very simple, very straightforward, a lot of fear. We took advantage of it. And I think, you know, there's a name that we own in the global portfolio, but we don't own it in the Australia, which is near and dear to Australia, which is CSL, plasma company. They might have a very interesting opportunity here with plasma as we address this COVID-19 crisis. And in most of our portfolios, ex-Australia, we added that name as well. So we like a lot of the names in the high quality healthcare area.
I can remember when Jeff Bezos was being interviewed, he reflected upon the dot-com crash. And I think he said that the share price dropped from $100 to $6 nearly overnight. And he said to the interviewer, he said, you know, our business hadn't changed one bit. You know, the people who bought books and videos and DVDs, he said, they hadn't changed at all because of the dot-com crash, but the market really had changed the valuation of our company.
Oh, yes. And, you know, Peter, I say this all the time. If most people approach the stock market or the equity markets the same way they approach buying a piece of real estate that they're going to live in, they would have much greater outcomes. Because with the real estate, you buy a house in a nice neighborhood or a not so nice neighborhood, and you own it, and you're going to own it for probably 10 years or 20 years. You never look at the price every day or every 15 minutes. You just know that over time, I'm going to do pretty well in this place. And that's how people need to approach the equity markets. And they just don't do it because they can look at their stock quotes every 15 minutes. And while that's great because you have liquidity, it's not so great for the temperament of the average person. It causes them to be much more active in equity investing than they should be.
One of your great fans has asked me to ask this question. Protecting capital in down markets is something the WCM Quality Global Growth Strategy has done very well historically. Now talk to us about the downside capture, what it means and how it's benefited the portfolio this year. And also, how did you achieve this downside capture without moving to cash, which a lot of fund managers have done?
Yeah, and you know, that whole idea of moving to cash is a fool's game. You know it, Peter. You've seen it. It's absolutely impossible to achieve success moving in and out of cash and in and out of stocks over time. Can't be done. If it could be done, trust me, Wall Street would build a product that was all about moving in and out of cash and in and out of stocks over time because they're about making money. But there is no product to that extent because it can't be done. So yeah, our focus on downside capture, as I mentioned earlier, you look at the benchmarks, benchmarks are the market itself is down 5.5%. We're actually up 9.6%. We've done extremely well because of the kinds of companies we own. Owning those businesses that I mentioned earlier that actually are taking market share in difficult periods of time or periods of market dislocations tends to be a great way to protect your capital when things get choppy. And also when that market eventually turns, which it always will. And I will tell you, for all investors, it really pays to be optimistic about the future. No matter how bleak it might look out there, you know, there is this relentless pursuit of things getting better, certainly economically across the globe. So if you stay focused on a very kind of optimistic viewpoint, I think that serves you very well. You know, just in general, don't lose as much on the downside, which we haven't. Means obviously you don't have to make up as much when the markets recover. So it's a good recipe. As I said, in the first quarter, we weren't down as much. Second quarter, we're actually up more. And the compound return over time is about 150% better than what you would have gotten if you just bought the index across the globe.
Paul, have you made any changes to the portfolio in response to the increased volatility?
We have, and you know, it's interesting because I have mentioned that we are very focused on the long term, and we try to keep portfolio turnover at a very low level, maybe 20% a year, which means, and by the way, half of that is trimming positions and adding to positions. The other half is trading out of stocks completely or businesses completely. So maybe we trade 5 or 6 businesses a year, not many out of the stock portfolio of 35. But when there are that period of dislocation, we took advantage of it. As I mentioned, we added to our positions in Boston Scientific and Stryker, a couple of healthcare companies. We also bought a really interesting name that was down about 70% from its highs. That's a little bit controversial to some people, mostly because they don't understand it, which is called Lululemon. Lululemon, as you know, is kind of the leisure wear, you know, franchise. A couple things going for them, you know, as this whole kind of lockdown has happened. People are working from home. Yeah. People are working more casually. Their e-commerce business is growing at over 25% a year, and they've made a massive shift towards men. Men wearing
Lululemon. Yeah.
Yes. So we bought that company at when it was down about 70%, and I think through today, and we bought it 2 months ago, I believe it's up roughly 100% so far. So, you know, got a great opportunity to buy that. There's also, you know, there's a company some of your people might have heard of called Ferrari. Again, kind of an interesting name because, you know, a lot of people have this concern that, you know, wow, when this economy has trouble, people aren't going to go out and buy Ferraris, and that is absolutely not true. They have a model that's basically built around premium pricing. What we found with luxury good companies, you know, a lot of people think about Ferrari as an auto manufacturer. We think of it as more of a luxury goods producer. And what we have found is there's a 2-year waiting list for a Ferrari, and they manage that, and they create that demand because of the high ticket price. So from our perspective, to buy companies like that people really don't like, and they believe the short term is going to be difficult for them, is the perfect place to enter into a position in that business, so that if you have a 10-year time horizon, you're likely to do very, very well.
Yeah. Okay, mate. You're also well known for using corporate culture as one of your investment criteria. Does culture become more or less important in extraordinary market conditions like we've seen so far this year?
Oh, much, 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 much more important. It all, to us, the ability of a business to grow its competitive advantage has everything to do with the core set of values in that business that animate what they do every day. So we really work hard on trying to make sure there's an alignment between the core values of the business and what they're trying to achieve from a strategy standpoint. And the more that you can find alignment between values and strategy, which leads to an increase in competitive advantage, the better your opportunities to make great returns. There are a lot of examples, if we had more time, where I could tell you how important corporate culture is to the long-term success. I don't care if it's a business, if it's a foundation, an endowment, a government entity. The values of that entity have everything to do with whether it's going to be successful going forward. And we put a lot of work into that. And it's very different because, most people on Wall Street, all they want to do is crunch numbers. They think there's magic in crunching numbers. There's no magic there. 20 years ago, there might have been. Today, everybody has the same information. So unless you do something different, and in our case around expanding moats or competitive advantages in corporate culture, you're not going to get a different result.
Yeah. Now, one last question, mate, and you and I agree on most things, but you might be surprised what I'm going to say here. I'm writing a story on the weekend, and the headline is going to be, "How could Buffett be so stupid?" Now, of course, that's the headline to get people to read it. I am going to conclude he's not being stupid at all. But some people would think so because he dumped airlines in America. I think he took about, you take about a $10 billion hit as a consequence of it.
Yes.
And that was May 4. And since then, airline share prices have rebounded extraordinarily.
Yes.
Now, talk us through the fact that even someone as great as Warren could make a mistake, and how people shouldn't think he's being stupid at all, but making a mistake like this is quite possible.
Absolutely. And as you know, Peter, everybody makes mistakes, even the great Warren Buffett. And the idea is obviously to minimize those mistakes. I actually think it's kind of, I was kind of shocked that Buffett was not a big buyer when that market pulled off really, really hard. It shocked me, and he wasn't, and he didn't move in. And they talked about kind of holding their powder, or he's got $128 billion of cash on the balance sheet. I was shocked that he wasn't gobbling up a lot of these high quality businesses. So, a little bit of a knee jerk reaction on his part, in my opinion. I can't really say that because he's Warren Buffett, but yes, people make mistakes, and that there's no shame in that. The reality is, in our business, minimize the mistakes, try not to make the same one over and over again. In other words, learn. And then just make sure that you have a few good ideas that really work over time.
I guess,
and if you do, you'll be successful.
Yeah, the last one is related to it. I think it's worth throwing in there that Buffett may well think there's going to be a serious second wave infections that results in lockdowns again. Now,
right.
And I know you guys don't think through the big macro issues because you're just looking for quality companies. But have you been forced to think about what second wave infections might mean to closures and therefore the success of these great quality businesses that you are holding?
I think if you're going to be invested, I'd rather be invested in the kinds of companies that we own in the event that happens. I think, I don't know. And as you said, we're not macro guys because we're inevitably always wrong on that. I think the probabilities of a second lockdown are pretty small, but let's just say that it happens. If it happens and you have an investment portfolio, you don't run to cash now. You stay invested in those really high quality businesses with expanding moats supported by a culture that's aligned with the strategy. If you do that, you will sail right through this, and 10 years from now, everything that we're experiencing this year and may experience later in the year is going to be a very, very small blip on the screen. The optimists win in life. They always win. So stay invested in these great businesses with really smart people running them, and you will create an awful lot of wealth.
Paul Black, WCM, thanks for joining us.
Always great to be with you, Peter. Thank you.
And by the way, I should add that WCM is a company that we brought to Australia to list on the Australian Stock Exchange. Clearly they were brought here because of their performance. They're now managed by Contango Asset Management. So you can go to contango.com.au for more details. There are 2 funds listed on the Australian stock market. One's called WCMQ and one's called WQG. Once again, thanks for joining us.